on. Perfect. And then, yeah. All right. So before we start, right, this class, I'm going to focus on two things, which is chapter 5, right, which is just a 15-minute refresher on what is the overview of reinsurance, what is the reinsurance value chain like, and what are the different types of RI agreements, right? So that is one big area. And the second big area is going to be chapter 6, which is the different types of RI products. And we'll go into each type, and we'll break down each product, and we'll identify what are the pros and cons of each product, and perhaps some exam level question solving as well, right? So
Sunil, can I ask something?
Please,
Sorry, can you give a
feel free to
brief
ask.
intro about yourself?
Oh, okay, sure. Feel free to ask questions in the middle of the course. Should not be a problem, right? So, brief intro about myself. I have a bachelor's in engineering, a master's in operations research, and I am an associate with the IFoA right now. I am one paper away from qualification, which is SA3. I have about 12 years. Okay. I have about 12 years of experience in insurance and insurtech. I currently work as the chief strategy officer of AssureKit, an insurtech company based out of Bombay. So I topped the SP7 paper and SP8 paper with the IAI. SP8 I topped in April 2021, I think, and SP7 I topped in September 2021. So I have quite a bit of experience with the SP papers because I give both the IFoA and the IAA papers. So I have solved quite a few of them, and hoping that we'll be able to solve questions together, and hope that you can use this as a launch pad for your SP papers.
Yeah, I've shifted to my laptop. That's why you would see.
Yeah, I figured that. Should not be a problem. Okay, so shall we start? So one basic question that you will often get for 2 marks, right? SP7, SP8, and SA3. So it's not uncommon for people to see what, they'll just put a 2-mark question saying what is reinsurance, what is retrocession, define fronting, or something like that, right? So I hope you are aware of all these terms. If you've studied it once, I'm not going to go into details because this is just too basic. If you're in any insurance vertical, you should know what reinsurance is. You should know what retrocession is, and you should know what fronting means. But if you don't know, let me know, and I'll go into it.
No, I'm comfortable with these.
Perfect. All right. So tell me, what is reinsurance? Like, give me your opinion. What is reinsurance?
Insurance for insurers.
Perfect. What is retrocession?
Insurance for reinsurers.
Perfect. What is fronting?
Fronting is like a captive which a big company has in front to insure themselves. So like a self-insurance.
Does fronting happen in India?
I think there are companies who have like, for example, Indian companies along with other insurers who have like mixed names.
Right.
They have fronting setups. That's what my understanding is.
Happens, but not as much as in the US.
Yeah.
So in India, there is a regulation where you have to keep a portion of the minimum portion of the amount that is fronted, whereas in places like the US, you can front 100% of the risk, right? You hold no risk. So in India, there are regulations around it, which makes it a lot more difficult, right? So I'll quickly touch upon the value chain because you already know it. It'll just be a refresher for you, right? At the bottommost layer of the reinsurance value chain, you have insurance or cedents, and their only job is to transfer risk. You have reinsurance brokers in the middle who act in facilitating deals, who take care of cross-border payments, which is a very important thing in the reinsurance value chain, right? So cross-border payments is one of the biggest problems companies like India face, insurers in India face, right? Because your reinsurer might be, say, a Lloyd syndicate, for example, right? In that case, what happens is that claim payments and premium payments become like a big issue because of the exchange rate and things like that, right? So reinsurance brokers often play a part in settlement of premiums and settlement of claims. They act as the payment gateway of sorts. It's not exactly payment gateway, but it's sort of payment gateway, right? RI brokers also handle claims. So when it comes to RI claims, RI brokers play a very important role there. So RI brokers are a very important cog in this wheel. Reinsurers, obviously central to the RI value chain, and they provide capacity. And of course, retrocessionaires, they provide access to the capital markets, right? So reinsurers will transfer risk to retrocessionaires, who then package the risk and securitize the risk directly onto the capital markets. Clear?
Yes.
Perfect. All right. Now, simple mnemonic, and this is often asked for about 5-6 marks, sometimes even more in SP7, SP8, which is, why do you want reinsurance? Why should companies take reinsurance, right? Simple mnemonic, it's past life. Can you tell me what this mnemonic means? And I'll tell you why mnemonics are, do you have experience with mnemonics when you study for exams?
So for me, the study technique was more about writing maps and points instead of mnemonics, because everything shifted online. So I didn't feel like mnemonic was any more relevant.
Okay.
But I have come across the past life one.
Understood. No, but I'll give you a pro tip over here. Even though the exams are online, mnemonics will help you a lot. And I'll tell you why they help you a lot, right? The first thing is that they make it easy for you to remember the material, which saves you time during exams, right? And that's the most important thing. When you're giving a 3 or 20-minute exam, you have only 2 minutes per mark, right? So if it's a 10 marker, you can only spend as at most 20 minutes on that question. You can't spend more than that, right? So what you have to do is you have to pick up marks at a quicker pace on the easier questions so that you can spend more time on the harder questions. So let's assume you have 2 10-mark questions, right? You can at most spend 40 minutes on that total, right? But the challenge here is that one 10-marker could be very easy and the other 10-marker could be very hard. So out of that 40 minutes, you can save 10 minutes in one and invest that 10 minutes in the second 10 mark. So understanding and remembering the mnemonics makes it a lot easier for you to generate points, which saves you time. My recommendation here would be to go through the mnemonics, right? If you have mnemonics, if you already have them, good. If you want to make your own mnemonics, feel free to make your own mnemonics, right? For example, my mnemonic that I used to have for reinsurance was not past life. It was something else, which was easier for me to understand, right? But past life is like a nice mnemonic. So I just put it. But if it were me, I would have made my own mnemonic, right? So, and I urge you guys to make your own mnemonic. I urge anyone who gives their own SP papers to make their own mnemonics, because that way you'll understand it and it'll be easier, right? So tell me what do the mnemonics stand for? So tell me, like, why do you take reinsurance? Why do companies take reinsurance?
I don't know about the mnemonic, but I can otherwise.
Sure. It's okay. Even if you don't give the mnemonic, just give me one, just give me like a sense so that then we can have a discussion, right?
Okay, first of all, to limit the risk,
Okay, good.
increase the capacity
Good.
for writing more business,
Right.
for catastrophes and everything where the risk can be
Increase
unlimited.
capacity for
Yeah.
catastrophes, for other risks, same point. Go ahead. Good.
Okay. Yeah, that's pretty much that I can think of right now.
Fine. All right. So I'll tell you all these points. And one more tip that I'll give you is that when these points are discussed, right, understand how these points are linked to each other, right? So I'll give you a simple point. The A in past life is avoidance of single large losses and claim accumulations. So why do you take reinsurance? You want to avoid, let's say I am Elon Musk and I go to Tata AIG and I take a $1 billion cover. I know it's idiotic, it's hypothetical, but let's say Tata AIG does agree to cover me, right? Now, if I make a claim for $1 billion, Tata AIG tomorrow will become bankrupt, right? That's that simple avoidance of large losses and aggregation events is one important thing, right? Now, how is that connected to everything else? avoidance of single large losses will ensure that my results are smoothened, which is the next point, smoothened results, right? Now, if my results are smoothened, it basically means that during the initial periods of an insurance company forming, results will generally be very volatile, right? Because you don't have experience. So effectively speaking, during the initial periods, reinsurance will generally tend to increase profitability because of smoothening of results. Clear? So that's one point, increase profitability, right? Now, if my results are smoothened and my profits are improved, what does that mean? My solvency is improved. So improved solvency is another point, right? India generally, which company do you work for, if I may ask?
Nah, I work with Allianz.
Bajaj Allianz, is it?
Not Bajaj Allianz, I've worked with Allianz UK.
Allianz UK. Okay, okay. Have you worked in the India market before?
I haven't.
You haven't. Okay. So back in say 2013, 2014, right? 10 years ago, the India market didn't have expertise when it came to product development, because most of the actuaries were based out of, like foreign markets, right? And there was actually a dearth of talent for product development. Now it's different. Now the talent has built up over the past 10 years. But back in 2013, right, almost all products were reinsurance driven. And when I say reinsurance driven, I mean that the reinsurer would help the insurer create the wordings, do the pricing, help with technical aspects of the product development, and the insurer would only file the product, right? So that is the last point, which is expertise. Reinsurers are considered to be experts when it comes to product development and product and insurance products. So more often than not, you will often see reinsurers helping insurers with their products. And if an insurer gets into a relationship with a reinsurer, they can expect product help with product, right? Technical help with product. So if it could be as simple as pricing help, it could be as simple as data for pricing, right? More often than not, when you're launching a new product, you won't have data for the product. What reinsurers will do is they would have run this product in some other geography, right? And this is a live example because we in my InsurTech went through that, right? Where we were launching a product. I think somebody has joined. 1 minute. Hi, Ankur. Can you hear me?
Yes, I can hear you.
Yeah, perfect. So you're a little late. We've started, but you can just ramp up, I suppose.
Yeah, sure. So I am in a bad network area, so I may not be able to start my video today.
Yeah, but I would expect you guys from next class to please start your videos.
Yes,
Simple
yes,
that I
sure.
see your face,
Yeah.
right? So
Yes, yes.
okay, so we're just exploring, or we're just having a discussion on why reinsurance is important, right? So sorry, Tanya, what was my last point? I kind of forgot. Oh yeah, with my company, right? So we had this actual problem, and the reinsurer was able to provide us with data from another market where the product was actually run. So while we did not have any data to go here, we could make adjustments from the data and come up with a pricing structure, right? So expertise is a very important point for reinsurance companies. Reinsurance, and this is a standard exam point as well, right? You can put expertise for any reinsurance related thing, and if it's context, as long as it's contextual, you'll get 0.5 marks without any problems, right? And more important than expertise is the financial assistance, which is the final point, right? Which is uh, reinsurers can provide you with financial backing. It's not just reinsurance related backing, it is also financial backing, right? Which is they can structure products in such a way that they can give you upfront capital and then recoup that capital later, right? And it could be structured as a FinRe product, which in theoretical terms is not even reinsurance, but it's just structured finance. So reinsurance often deals with a lot of structured finance problems. And clear?
I quite didn't understand what is can you repeat like structured finance? I didn't.
So okay, so we will discuss this through when we discuss the FinRe aspect, right? Sometimes what happens is that reinsurance products are not structured as premium payments and claim payments. So these are called pre-funded and post-funded arrangements. So what the insurer and the reinsurer will do is the reinsurer will give like a bunch of they'll give like a bulk of money to the insurer and they'll call it claim payments, and then they'll recoup that money later. So this is called structured finance, right? And effectively it is designed as a reinsurance agreement. However, it is meant to provide financing solutions to the insurer.
Okay.
Okay. Shall we move on?
Yeah.
Perfect. All right. So this is the same points that I've mentioned, right? Which is, why do you take RI? And it's a straightforward thing. And Ankur, you were not there when I was telling you, when I was telling Tanya. Make sure that you get mnemonics in place. And the reason is very simple. It saves you time during the exam because recall is faster. And it gives you the ability to finish easier questions faster, right? And in the exam, you only have 2 minutes per mark. So if you have a 10 marker, you can only spend 20 minutes. So if let's assume you get a 8-mark question for why should a company take reinsurance? This is a straightforward question that you can finish in 2 minutes instead of 16 minutes. And you can then spend the remaining 14 minutes of that the time that you've saved on harder question, and it becomes easier for you to pass the paper. So if you get mnemonics, please ensure that you memorize the mnemonics and make sure that you are able to recall it during the exam, right?
Understood. Yeah.
All right. So what are the methods of writing reinsurance? Are you aware of this, both of you? Methods of writing. Do you know what fact is, what treaty is?
Yes.
Yeah.
I'm aware.
You're aware of it? Okay. All right. I'll just go through it 30 seconds just so that you can refresh it. 2 methods. One is facultative, one is treaty, right? Facultative is basically when the risk is, when the reinsurance risk is written individually, the reinsurer has the option of accepting and rejecting, and each case is separately underwritten, right? Treaty basically means group of similar risks. There's an arrangement between the insurer and the reinsurer. 2 types. One is oblig, where cedent is obliged to place and RI is obliged to accept. There's no choice. And then there's fac oblig, which is cedent has the choice to place, but the RI is obliged to accept, right? This is often asked as like a 2-3 mark question, right? What is the pros and cons? They'll just say, what are the pros and cons of fac versus obligatory and things like that, right? So they have not asked this particular question over the past, I think 4, 5, maybe 7 years, but very easy for you guys to actually learn this through the mind map that I've created. And, just refer to this. And if they ask, it's an easy 2-marker, right? Which is pros for treaty is very simple, right? Since it's a oblig or a fac oblig and the agreement is already in place, it's very easy to administer. It's also efficient because you don't have to go to the underwriter each time the risk comes to your box, right? And there's also certainty. So when a risk is placed when a quote is given from an insurer or asked from an insurer from a client, if a treaty is in place, the underwriter, the direct underwriter will always know that this can be placed directly with this insurer. Of course, there are a lot of cons with treaty as well. And the biggest con being inflexibility, right? Once a treaty is made, cannot be changed, very difficult to change, can be changed, anything can be changed, but this is very difficult to change. And it is also very time consuming to set up because we all know insurance is a very slow industry and reinsurance is a little slower. So have you guys worked with reinsurance treaties before?
Not directly, but being in the reserving team, yeah, I have to go through it.
Yeah, so you understand how difficult it is to change things, right? So it's very
Yes,
time
yes,
consuming. So it's very time consuming to set up, right? So that's the thing. With respect to fac, so I'll tell you one trick over here in exams. If you get pros and cons for multiple things, sometimes the pros of one aspect is the cons of the other aspect, right? So for example, in treaty, one of the pros was easy to administer and one of the cons was inflexible. Now, in fact, the flexibility is the pro. So when you're dealing with, these kind of pros and cons, advantages and disadvantages questions, sometimes it helps to understand where the advantages are and disadvantages are, and then you can flip for the other question, right? Sometimes they'll ask, what is the advantage and disadvantage of faculty and treaty? So when they ask this, they might ask it for 4 marks. So you can basically change the wordings in such a way that you get 0.5, 0.5, 0.5, 0.5 marks each, right? So it becomes like a neat trick that you can quickly get. You might get like 1 or 2 marks more, and that 1 or 2 marks might generally be the difference between pass and fail. So hopefully this will help you, right? So again, pros for FAC, flexibility. Cedent can use different RAs. That's the most important thing, right? When you have a treaty, you can't use different reinsurers. It has to be placed with the same treaty. Whereas if it's a FAC, you can select how many reinsurers you want. Cons, again, underwriting is a pain, very time consuming. It's very inefficient. There's also the question of availability, right? If a customer comes to you and you are the underwriter and says that I have a $5 million risk that I want to place, I want to give you $400,000 in premiums. You don't know as an underwriter, if you don't have a treaty, you don't know whether it can be placed because you don't have the risk appetite. You have to find a reinsurer and you don't know whether the reinsurance premium will be acceptable to you. So cost and availability of reinsurance will become a big question for any risk. So often treaty and FAC are used in combination. You'll have some lines which have some treaties and you'll have some lines which have some FAC, right? So it's a very contextual point for you to add in your exams. If they say, give your opinion, right? You can always give a valid opinion that's there. So let's move to type of RA. I'm pretty sure you guys are aware of this. This is just going to be a refresher, right? Proportional, non-proportional, FINRE, and alternative risk transfer mechanism. So these are the 4 things that are there. Most of the questions that get asked are in the proportional and non-proportional areas. However, in the exam, if you do mention FINRE as a added example, right? Sometimes what they'll do is they'll tell you, they'll ask you, can you explain or can you describe what reinsurance covers that this particular case can take? So they'll give you a case, right? They'll say a small insurance company is underwriting is a specialist underwriter of, say, property. And then they'll give you a case study and then they will ask you, describe the reinsurance policies that this company can take. Most of the exam marking will also be around proportional and non-proportional covers. However, if you can explain FINRE as a product and if you can give a reason, you can actually get extra marks, right? You can get 1 mark. It's a source for you to get extra marks. So FINRE is something that is generally not, studied, but makes a good sense for you to spend a little bit of time studying FINRE products. So let's look at the next set of, the next part of the class is effectively going to be around proportional, non-proportional, FINRE and ART. And within proportional, we're going to look at quota share and surplus. Within non-proportional, we're going to look at XOL, stop loss, and runoff solutions. Within FINRE, we're going to look at, like I mentioned, pre-funded and post-funded arrangements. So those could be time and distance deals, spread loss covers, financial quota shares, and things like that. And within ART, which is a very small topic, which has never been examined, I think, ever, because I've looked at the past 20 years and I could not find any securitization questions. So it's securitization and structured finance, which is another complete area. So we will not be covering that specifically in this topic, but if you have any questions, more than happy to take it up in either this class or the next one, right? So let's move ahead. Quota share. Simple. Form of proportional treaty. It's basically an apportionment agreement between the insurer and the reinsurer. The insurer says, I will cede X% of the premiums to the reinsurer. the reinsurer will say, I will give you in return for X% of premium, I will give you X% of claims, right? Quota share can be taken on a FAC or treaty basis. Generally, rule of thumb in the market, it is taken on both. So sometimes you have, for very large risks, you will have a separate quota share treaty, the quota share FAC agreement that is there. Most of the reinsurance treaties are quota share. For example, motor, you would have definitely seen quota share agreements in motor. I'm pretty sure about it, right? What is the advantage of quota share for the insurer? Can you guys tell me what the advantages and disadvantages are quickly before we move on to the advantages and disadvantages? What could be the advantages and disadvantages?
First, it's easy to administer since a fixed proportion
Correct.
of premium as well as claims is going to be ceded.
Correct. Good point. Next.
It could mainly help in reducing the variability.
Good. But variability is how is variability reduced? Because quota share is, I am ceding the same proportion, right? There is no variability that's reduced. So if I have, let's say I have a agreement in place, right? And I agree for a 90% quota share. So how is variability reduced?
Because the absolute amount of claims paid by the insurer will get reduced. And because of that, the variability may come down.
No, but my variability is still there, no?
It is still there, but
I am ceding the same proportion of high risk and low risk risks. So I might have two property risks, right? One might have a very high probability of getting a claim, and one might have a very low probability of getting a claim. But for both those risks under the quota share treaty, I have to cede out 90% of the premiums. So my variability is still there in the portfolio, no? It's just that it's 10%, but the variability is still there. Variance is not reduced. Mean has reduced.
correct.
So what else? You're somewhere there. It's not
I guess
variability.
all the reinsurance advantages apply to quota share as well. But if specific to quota share, it would only be because it's proportional and yeah, easy to administer is one of them, and the other one is
This
you
slide has
can.
one answer. You guys are missing something which is there on the slide, which I have not touched upon. It's there in the slide.
Oh, the loss ratio is same.
Not an advantage or disadvantage, but chalo, I'll give it to you guys. But there's one more. You guys are missing it.
The commission.
Yes.
Okay.
It all comes down to commissions. Commissions help with the cash flow. I cede 90%, I get 3% back in commission. I might get a profit commission of say 2%, which means that if I underwrite well, this will actually make money for me. So that's one important aspect. Second important aspect is something which Ankur kind of mentioned, but did not mention it correctly, which is it spreads risk and it increases my capacity to accept risk. No, that's the main point of reinsurance, right? Increase capacity to accept risk. So it improves my risk appetite. I can, as an insurer, I can go and I can participate in large risks because of quota share. So my solvency could only be 100 crores, for example, which means that I can, let's theoretically assume that I can write risks 10x the risk, right? Which is 1000 crores. Now with a quota share treaty, I can go for a risk, which is say 3000, 4000 crores. And I can say cede 90% of the risk and I can keep the remaining risk and I can participate in the market, which is very important, right? So it improves competitiveness. It improves capacity to accept risk. So those are the important aspects of quota share. Of course, commissions are important, but the more important aspect of quota share is the ability for companies to compete in the market against other larger players. So I am also a larger player now, right? Because if I'm a very small insurance company and I don't have a quota share agreement, I am stuck. I can't insure a lot of risks. So this gives me competitiveness. right? So I'm going to go to pros and cons quickly, right? Easy to administer, pros, commissions help with cash flow, helps lower solvency, right? So now I can become more competitive in the market, and it spreads risk, which is the most important aspect. Cons, like we mentioned, I cede the same proportion of risk to the insurance company. I might not want to do that. Like I mentioned in my example, I might have two property policies, one with a higher risk of claims, one with a very low risk of claims. I might want to keep more of the low risk of claims, right? I might want to cede the higher risk of the policy with the higher risk. I might want to cede more of it because I'm a, like I'm an insurer, I'm out for profits, right? So that's one disadvantage of quota share. I can't do that. The second is that the profit is shared. So in my example of 90-10 quota share, I cede not only do I cede 90% of the premiums, I also cede 90% of the profits. I might get a profit commission, but market forces might force me to ensure that I don't get a lot of profit commission, right? Which means that I have to cede my profits away. And the same proportion of low and high variance risk is ceded to the quota share treaty, which is another problem for me, which means that if my underwriting is not good, my loss ratio is still going to be high, which does not which it might lower my solvency. I might have no problems from a solvency perspective, but I might have a lot of problem from a profitability perspective. And this is something that an insurer has to worry about, right? It's not just solvency that actuaries have to worry about. It's also profitability. So this might solve one problem, but it might not solve the other problem, to which we will make a nice segue and we'll come to surplus, right? Now, before we come to surplus, I'm very interested. What do you guys know about EML, MPL, and PML? So tell me, what is EML?
Expected or estimated maximum loss.
So what is, okay, what does expected maximum loss mean?
The expectation of the possible maximum loss.
Okay, fair enough. What is PML then?
That is possible maximum loss.
Probable maximum loss. Okay, what is the difference between PML and EML?
The same difference which is between expectation and the maximum value.
Okay, then what is MPL?
Oh, okay. So maximum probable loss, that's probably the maximum value. PML and EML are same, I think. And
Okay.
MPL is the maximum value.
Okay. Ankur, what is your answer?
So I haven't heard about MPL, but
Okay.
I think the difference between EPL, the expected maximum loss, is the theoretical loss that can happen to a particular risk.
Okay.
And probable maximum loss, maybe it's the basis the probability distribution of the loss. Let's say if we consider that the maximum loss could be on the 99th percentile
Okay.
of that probability distribution, that is the PML, according to what I understand.
You are fairly there. You are almost there, not fully there, but you're almost there. So
Okay.
EML, PML, and MPL, they're all estimates of the maximum loss that can happen, right? They're all estimates of maximum loss. What is different is the number of scenarios that are considered in the estimate. So in EML, and EML is called estimated maximum loss, right? It's sometimes expected maximum loss is also used. However, the more accurate, in my opinion, term is estimated maximum loss, right? It is effectively the number of scenarios which are considered within the realms of probability, right? You will ignore any remote coincidences, even if they're possible. So what does that mean? It means that if something is considered unlikely to happen, it should be ignored in the EML calculations. So until 2019, for example, when you're doing, I know health is not part of SP7 and SP8, but let me take a health example just because it's easier. Until 2019, pandemics were not that big of the thing, right? So in your EML calculations, pandemics would never be like accounted for. PML is probable maximum loss. And this is also called the bad case scenario. So the probable maximum loss is estimated based on elements that take into account all aspects of the risk. What this means is that you would consider the worst case scenario and the incident that triggers the loss that took place in the worst place at the worst time. So effectively speaking, PML considers more scenarios than EML. So PML is generally higher than EML, right? And then MPL, which is maximum possible loss. So you have to understand this. There is a difference between the words here, right? One is probable and one is possible. Probable means there is a realm of probability that's happening. Possible is worst possible case scenario, right? This is the worst estimate of loss that you can think of. So in most cases, it is generally, there's no probability event that is there. There's no weighted average that is there. This is the absolute worst case scenario that is generally called the MPL, the maximum probable loss or maximum possible loss, right? So most of the time, EML is the, what is there? EML is used, like it's the most used metric. However, it's a good idea to know this because I know for a fact that SP7 had one question of 6 marks on why EML was a good metric. And if, if you had written what's that, SP7 or SA3? I think it was SP7 if I'm not mistaken. And yeah, you will be in a position, if you know these 3 differences, you'll be in a better position to answer those questions, right? So good segue. And let's come back to surplus. What is surplus? Again, proportional RI. The only difference between surplus and quota being that the proportions of each risk are determined for individual risks, right? So I'll give you 3 examples and let's take a hypothetical company that has a $200,000 limit. So let's say that a risk with EML of $400,000 comes to the company. So the company can choose to take a surplus for $200,000, retaining $200,000, and it can cede 50% of the risk, right? So $200,000 is retained. If the surplus treaty is agreeable, they can even retain a much lower amount and cede a much higher amount, right? Let's say that in the second example, company still has a $200,000 limit. They can't accept risks greater than $200,000. Now, what happens is that, let's say an EML of risk with an EML of $1 million comes to them, right? In this case, a quota share would not work because quota share, cedes the same proportion of risk for every risk. Whereas with a surplus treaty, they can choose to retain only $200,000 and they can cede the remaining $800,000. So now we have 2 risks, one with an EML of 400,000 that was insured and one with an EML of 800,000 that was insured. The absolute limit for the company has not changed, $200,000, but the amount that has ceded has been changed. And this is the beauty of surplus, right? Now, in the third example, let's say that this another risk with an EML of $1 million comes. The company is very hesitant to insure the risk because they feel that it's a very risky proposition, right? Now, the underwriter takes a call because the sales guy is after the underwriter's life to insure the risk. And, it goes up to the management. Let's think, because you guys have been in that scenario, right? It goes to the management, sales team makes a fuss sort of things. Manager, CEO comes and says, no, we have to insure this risk. It's a big client. So the underwriter then decides, okay, chalo, I am not going to put money where my mouth is. So I'm going to only take $100,000 as a retention for this risk, and I'm going to cede $900,000. So now, in these cases, the first case, we've ceded only 50% of the risk. In the second case, we've ceded 80% of the risk. And in the third case, we've ceded 90% of the risk under the same treaty. So this is the beauty of surplus, right? Now, given that we have discussed this, I want you guys to tell me what are the pros and cons of surplus. Hello?
Yeah. On this point, Sunil, so when we were discussing the advantages of quota share,
Yeah,
You mentioned it sees the same proportion
Correct.
of all risk.
correct.
Now that point is not valid for surplus.
Perfect. So that becomes an advantage. Good. So why is that an advantage? So the point is correct. Now the question is why. So how is that an advantage, and how and why is that an advantage?
Okay. So it is an advantage because it would limit the losses for the bad risk.
Correct. Good. And what does that mean?
Everything improve profitability,
That is
improve
the point.
loss ratio, improve
Yeah,
solvency.
that is the
everything.
point. That is the point. So I'm running this exercise because that is the answer that the insurer that the institute is expecting, right? It's not just I can have flexibility, but it is that there is an impact on profit. So the point there is improve profitability, right? Now, you mentioned about different limits, right? Now that gives me the ability to choose how much I want to see, right? Now, why is that a problem? Why is that an advantage?
Sorry, I didn't quite understand your question.
No,
We
your
already
point, your initial point that you mentioned was that you said that the insurer can choose how much he wants to cede.
Yes.
So that basically means that the insurer has a choice.
Hmm.
Why is that an advantage? One is improved profitability that we discussed, right? Now, tell me another point. Why is that another advantage? Like, where is the advantage again?
It limits the losses, which is
Correct.
also like
It spreads the risk. The answer is it spreads the risk, right? And it enables, we have seen here, right? It enables the insurer to write much, much larger risks than what they can retain, which is also the case, with quota share. However, with surplus, you can effectively limit how much you're retaining, right? With quota share, there's no that limit kind of sort of does not exist, in the sense that you are just getting into an agreement where you say that chalo, I will cede 90% of the premiums, you make sure you pay 90% of the claims, right? Whereas here you can say that I will not insure more than $200,000, and you have a hard limit over there, right? That does not exist in quota share. So
how is it proportional then? I think it is only used to set a proportion, but it is still proportional. I mean, if it's unlimited, it would be unlimited according to that proportion.
not unlimited, no. That's the thing. There is an upper cap. So it's proportional because let's say that this second case, the second example, right? Let's say that this gives a claim of $1 million, or let's say the claim is say $300,000 for the second example. So the second risk has come. You have retained $200,000, right? $800,000 has been ceded. That's 80% ceded. Now, if there's a claim for, let's say $100,000, makes math easier, right? If there's a claim for $100,000, the reinsurer will give you $80,000, and you have to pay $20,000 from your pocket. Clear? That is where the proportionality is.
Okay.
Proportionality does not come in the calculation. The proportionality comes in how much percentage has been ceded. So the percentage ceded, the calculation for the percentage ceded is different.
And what is the limit? Limit would be 1 million.
No, the EML is 1 million. The limit could be anything.
So there is no limit, right? If
No, there is a limit. Let's say the surplus treaty has a $5 million limit, for example. In this case, you can insure if there's a $5 million limit, you can insure an EML of $1 million. However, if the surplus only has a $500,000 limit, the second example cannot be valid. You can't insure it, no? Or you can insure it, but you have to retain the first $200,000. Then you can create a surplus for $500,000, and then the last $200,000 you either have to find another surplus treaty, or you have to find a quota share, or you have to absorb that within yourself. So your liability is split into 3 layers.
Okay.
If the surplus treaty is smaller, generally speaking, it is not uncommon for insurers to have multiple surplus treaties.
Yeah.
With multiple lines. We'll discuss what lines mean and things like that. So good. I think
But in example number 2, if
Ah.
I have a 2 million claim,
1 minute. Let me open that. Huh.
if I have a 2 million claim, and
Same
this
80%. 80% will get.
80% I'll get, even
Yes.
though the claim is more than the EML.
Yes. Provided it's under the limit. Provided the surplus, the limits are not breached for the surplus contract, you will get it. You will get 80%. Let's say that you have a surplus treaty of $5 million. You will get 80% of the, you'll get 80% of 2 million.
Okay, so if it's exceeding 5 million, like 6 million, then up to 5 million.
You'll get up to 5 million. Yes.
Okay.
Generally speaking, it is a very bad form for an insurer to underestimate EML. And I think a good point, a good homework for you guys would be to understand what is the impact of underestimating EML for an insurer. Think about it and ping, and we'll see. Next class, we can hopefully discuss it, right? It's a good thought process. Think about what happens if the insurer underestimates EML. What are the long-term ramifications? All right. So quick terms. Minimum retention.
Just one question.
Yeah, please go on.
Can we, in a way, say that surplus is a combination of risk XOL and quota share?
We can't say that. Because risk XOL is very clear, right? It is monetary. Anything above this
Correct.
is covered in a risk XOL, right? Above a particular thing.
In a way, what I'm saying is, in a way that we'll select the limits and everything. So
Yeah,
in
I
XOL, what we do is.
No, I understand your point. It is a very valid question. It's an extremely valid question. But my opinion is that XOL and proportional are two different classes of reinsurance. So what happens is that you can't combine one and the other. So you can't say that risk XOL plus quota share is equal to surplus. Like, in the sense, I'm not sure if anybody will agree on that. This is my personal opinion, right? I would not agree with that statement. Although I do know that it sounds appealing, right? It sounds appealing to understand or make that statement. I agree there, but I would not agree with it on principle.
Understood.
All right. So quickly, I'll go through the pros and cons before I go through the terms, right? Like I mentioned, insurers can write larger risks. Insurers can have the ability to choose what limits they want to cede. Very useful when wide variation can occur. And this is often a question that comes. Where is quota share? Where is surplus useful? For example, commercial property is a perfect fit for surplus treaties, while things like motor is a perfect fit for quota share. And why is that the case? Can anybody tell me?
Mainly because of variability. The variability in commercial lines is very high.
Exactly. Commercial property, you will get a risk for $1 million and $100 million. Whereas in motor, the risk sizes are more homogeneous. This is a very important point. You have to answer contextually in the exams, and this will help you understand those contexts, right? It also helps spread the risks. And the final point, which is a simple 0.5 marks, whenever you get these kind of questions, please always remember $. Commissions. Commissions help with cash flow. All proportional treaties give you commissions, right? It is a major factor that drives insurers to even take proportional treaties, because they know that they're going to get commissions from the reinsurer. Biggest con is that the administration is very complicated. You have to think through a lot of things when you have a surplus treaty, and it is also unsuitable for some covers. So for example, in India, motor liability, TP liability is unlimited, right? Surplus cannot account for that, right? So surplus treaties are generally unsuitable for unlimited liability covers. So that is one of the biggest cons for surplus. Quickly, I'll go through the terms. You have to understand and remember 4 terms. What is minimum retention? Minimum retention is the minimum level of risk that the insurer should accept on his books. Maximum retention is the maximum level of risk that can be retained. So the insurer has the option of retaining between small r and large r. Number of lines is basically a metric that is used to calculate the level of cover provided. And the maximum risk size is the simple equation, which is 1 plus number of lines times maximum retention. So simple, I'll give you a simple example. Let's say that you have a surplus treaty with 5 lines of cover and a retention of $5 million. It means that with that surplus treaty, you can insure a risk with an EML of up to $6 million. If a risk is under $6 million, it can be, it can be covered under the surplus treaty. If the risk is more than $6 million, you can cover up to $6 million with a retention of $1 million with this surplus treaty. But for the remaining surplus treaty, for the remaining risk, you have to find another reinsurer or another surplus treaty, or you have to accept yourself. Clear?
Can you explain what exactly this number of lines means?
See, number of lines is effectively a metric that is used to calculate what the maximum risk size is going to be, right? Effectively speaking, what happens is that when you have number of lines, the reinsurer, the underwriter, the direct underwriter has the ability or the flexibility of determining how much cover is going to be ceded to the reinsurer, which is why that L is there, right? So for any risk, let's say in this example, right, where there are 5 lines of cover, the reinsurer can choose to insure only 3 lines, to take only 3 lines, right, out of 5 lines, in which case it means that that particular underwriter is choosing to insure more of the risk with themselves, choosing to net more of the risk with themselves and cede less of the risk. So that L gives you the flexibility. Effectively speaking, in this particular example that I mentioned, when it's 5, it means that you can cover, at most you can cover 6 million when you have 5 lines of cover. So if you take lesser lines of cover, it means that you can play with 2 variables here, right? So you can play with either number of lines or maximum retention. So let's say you have, yeah, I'll give you an example, right? Sorry, I'll give you an example, right? Same question, 5 lines of cover, maximum retention of $1 million. Let's say minimum retention is 0. Right? Which means that you can cover a risk of up to $6 million. Now, let's say that you get a risk for $3 million. Now, when you get a risk for $3 million, what all can you do? You can play around with 2 aspects now. You can play around with number of covers, right? Which means that you can choose to insure 2 lines and you can retain $1 million. That's $3 million. Or you can choose to use all 5 lines, in which case your retention is not $1 million, right? You are retaining 1/6 of $3 million. You're retaining only $500,000. So these 2 variables gives the underwriter the flexibility to cede how much ever they want within the confines of the surplus cover.
Understood.
Clear?
Yes, yes.
Tanya, clear?
I'm just confused on one thing. So other than the calculation, what is the significance of maximum retention? Does it also mean the limit?
It also means the limit. It's the amount of risk that the insurer can retain.
Okay, so in the previous slide, when you mentioned 5 million is the limit, that means maximum retention here would be 5 million.
In this slide?
Yeah. When we
mean,
were
yeah,
discussing.
I mean, in the sense this is $200,000. This
Okay.
maximum retention. This was just a simple example. Yes, you're right though. Minimum retention is the amount that the company has to retain. Maximum retention is the amount of risk that the company can retain. So there are 2 You have to understand the keywords over here, right? One is has to, and the other is can.
Okay, don't we take EML as R, like the capital R, a lot of times in
Most of the time EML is taken as the capital R. So depends, right? So sometimes I think I was attending a seminar by GIC where they were mentioning that for some lines they look at PML and not EML. So could vary from insurer to insurer, reinsurer to reinsurer, market to market. Generally speaking, rule of thumb, EML is a very good estimation to. It's not a, it's a good guess. EML would be a great guess to hit when you're talking about these things.
So any loss above EML is generally not insured.
No, it is insured. See, EML is nothing but your estimate, right? It's the estimate of the maximum loss. So you're telling them that in good faith, I think that this risk can give a loss of up to $2 million, right? And you're telling them that this is the surplus treaty. Now the surplus treaty could be 5 million or 6 million. You would still, if the loss exceeds 2 million, as long as it's under the surplus, you'll get covered proportionally to what has been ceded.
Okay.
All right. So I don't know if you guys can work on this question. Would be nice if you guys can, because this is a simple question. And I think this will solidify your understanding of surplus, which is the biggest aspect of this entire chapter, right? First question is, direct writer has a surplus RI treaty, maximum retention of $80,000. There's no minimum. 8 lines, right? Now there are 3 claims that are there with different EMLs. Can you calculate what the claim payouts are? Calculate it for one, that's enough. Let's do it for the first claim. Before you calculate it, can you tell me what assumptions you're going to make? Do you guys have access to a calculator now?
No, not really.
Okay. Tanya, you?
I'm using Excel. So
Yeah,
this is
that's fine. Use Excel. Why don't we take 2 minutes? I think we have only about 10 more minutes, but yeah, let's try to close it out. So the first question right now is, what are the assumptions? So tell me what the assumptions you're making are. And I'll tell you why I am choosing to answer to structure it this way. Shall I mention it? Shall we go?
Yeah, I don't remember exactly how I used to do it, but
Okay.
it was something like EML minus maximum retention, and that should be a multiple of
No, you don't even
EML,
need,
something like that.
no, you don't even need to do that. It's a very simple calculation. So the first assumption, when you get this question, when you get, let's say this is a question that you get in your exam, right? The first thing you have to do is state your assumptions. Always. If this is a 5-mark question, assumptions will give you 2 marks. You might be completely wrong. Your answer might, instead of the question might ask calculate the payouts, and you might say fish as the answer. But as long as you have valid assumptions, you'll get 2 marks. Right? Step number 1. Always when you have these kind of questions, state your assumptions. And your assumptions should not be wild. There should be a level of common sense in those assumptions. And that's something that you will know when you practice a lot, right? When you start practicing any actuarial paper, you'll start making common sense assumptions. So the first common sense assumption that you can make here is that the company will choose to retain $80,000. You remember, there is no minimum retention. There is only a maximum retention, which means that depending on whether the company chooses to cede or retain $40,000 or $50,000, $60,000, the answers change. So if you don't make this assumption, if you don't state this assumption, and if you write the answer, you will not get full marks. So if this is a 5-mark question, and if you just make the assumption of, retaining 80,000 at all times, and then you just make the calculation, your numbers will be right. They'll still give you 3 out of 5. Simple. Or 2.5 out of 5. Or if they're really in a bad mood, 2 out of 5. And it's happened, right? So make sure you state your assumptions. So let's go to the calculation. First thing is company cedes maximum possible retention, right? So let's look at maximum possible retention. So what happens for the first scenario, right? If I keep $80,000 as the retention, that means that the amount ceded is $160,000 because the EML is $240,000, right? Now, what is that? It basically means that I am ceding $160,000 divided by $240,000, which is 66.66% of the risk. So if I cede 66.66% of the risk, it means that I am going to recover 66.66% of the claim. So that is basically 66.66 times $12,000. My recovery is going to be $8,000. Clear?
Yeah.
Yes.
So, cool. We have to replicate this for the other 3 things as well. I will not do that. You can do that on your own. I will share this question separately to you guys. You can do that on your own. Let's move on because unfortunately, we have very less time now. So let's move on. I think it's already been 80 minutes since the video started. All right. Chalo. So let's quickly go through the XOL product. Are you guys clear with surplus? Do you want some other discussion on surplus?
No, nothing.
Okay, cool. All right. So XOL, very simple, non-proportional reinsurance covers indemnification above a stated excess point, which basically means that here is a product, $1.5 million, excess $1 million, which basically means that the cover is for a layer of $1.5 million over and above $1 million. So any claim above the deductible of $1 million will get covered up to $1.5 million. XOL, the beauty is that it's not only a feature of XOL, it's a feature of every other RI product as well, can be stacked on top of each other. And higher layers get activated only when lower layers get burnt. This is a feature of XOL, right? What do you mean by burnt? It basically means that there is claims that have breached that layer. Terms that you need to understand: retention and deductible. Working layer. Do you guys know what working layer is?
Where this XOL gets triggered, the
Layer
about the retention, about the retention.
Correct. Layer above retention, not where it gets triggered, but where the maximum loss is expected. And remember, these are all 1 mark, 2 mark questions. So you have to remember these for sure, because if you get asked this question, it's a simple 1 mark, 2 mark, right? What are index limits?
Is it related to inflation when
It is.
you have to increase the limit according to inflationary index?
It is. It is limited. It is related to inflation. And you are right. And what is the clause? What is the specific clause that allows for indexation in a RI contract? It's called the stability clause. So if the RI contract has a stability clause, it means that year on year, the limits will get indexed according to an inflation index, right? Can you guys define reinstatements?
When you have burned through some portion of the layer or the whole layer, you can reinstate that.
Correct. That is called reinstatement. It's restoration of a cover following a claim, right? Now, reinsurers could offer free reinstatements or paid reinstatements depending on the particular XOL treaty. And generally speaking, once the reinstatement has been exhausted, no further claims can be admitted unless and until there is a specific clause in the contract which tells you to do it, right? I had this question, but I have a feeling that it might be time consuming, but I will make this question. Let's see. So there is a $1.5 million excess $1 million XOL treaty, and this has the following terms and loss history, right? First term is upfront premium of $300,000 paid, one reinstatement at 140% of additional premium. And there have been 4 losses in chronological order, which is 2 million, 5 million, 1.8 million, and 10.2 million. Can you guys calculate the recoverable losses and rate on line for this? So what is rate on line first?
I don't remember it, but I've studied some kind of ratio.
Correct. It's the ratio of premium paid to the width of the layer. So what is the width of the layer here?
1.5 million.
Perfect. Perfect. That is the width of the layer. Very important note, when you're calculating rate on line, you should not calculate reinstatement premiums. It is just the pure premium paid, right? So just one important point. Okay, so let's calculate the recoverable losses here, right? So I've put a simple table, right? Each claim and what is the main assumption I've taken over here? Can you guys, you've seen the calculation that I've made, right? What is the assumption that I've taken over here? I specifically not mentioned the assumption, and this is actually in the CMP, but the assumption I have taken is different from the assumption that the CMP has taken. So that is one important point for you guys to note.
Can you go back to the question once?
Sure.
Okay, now the answer.
So let's go one by one. First claim.
So is the assumption taken here is that the reinstatement will be triggered only when the entire 1.5 million will be exhausted?
Perfect.
Is that an assumption or is that a
That is the
given?
assumption. That is the assumption. That's perfect.
Okay.
You got it spot on. What is generally the assumption that gets taken is that as the claim is filed, the reinstatement premium is taken on a proportional basis. So for example, they will take, like you will say that, okay, in the first case, I paid a cover of, say, I made a recovery of 1 million. Here is the reinstatement portion for $1 million, right? And when that exhausts, it gets exhausted. But here I have taken a more simplistic assumption, which is that the reinstatement gets triggered only when the cover is exhausted, right? So this is also a valid answer. You can make this as long as you state the assumption upfront, right? Now, had this been an exam question and had I only put this as my answer, right, I would not get full marks. I would get, if it's a 5 marker, I probably will get 2 marks, 2.5 marks, right? But the moment I make that one line, which changes the entire marking schedule for me, the moment I put that one line, which Ankur just said, I get full marks. or at least a majority of the marks. Chalo, full marks might not be difficult, might not be possible, at least a majority of the marks, right? So let me go through this example quickly. First, I'll go through it only for two claims, right? First claim, $2 million. What is the recovery? I have a $1 million recovery. I have a liability of $1 million that I have to pay. The cover remaining is 0.5 million because the excess layer is only 1.5 million. Reinstatement does not get triggered because of my assumption. I don't pay any reinstatement premium. Now I get a $5 million claim. My liability is 4.5 million because the cover remaining is only 0.5 million. Now at this point, the cover is exhausted completely, which means that I have to pay reinstatement premium. And I trigger the $420,000. I pay $420,000 because reinstatement premium is 140% of additional premium. So 300 into 1.4 is $420,000, right? Third claim, again, 1.8. This is the same as the first claim. And the fourth claim, what happens is that the cover is completely exhausted and there is no reinstatement premiums. There is no there's no trigger that happens. Clear?
Yes.
Okay, chalo. Perfect. So types of risk, types of XOL, three types: risk XOL, aggregate XOL, and catastrophe XOL, right? Risk XOL and catastrophe XOL, fairly easy. Risk XOL is XOL for large individual risks, can be taken on a treaty or fact basis. Cat XOL operates on a very high level. The event for the Cat XOL is defined very, very carefully. And more often than not, Cat XOL has something called the hours clause. What is the hours clause? Hours clause is basically the time period before which the insurer has to report all claims for a catastrophe. So it's generally 72 hours. Aggregate XOL is basically an extension of risk XOL and acts on a cumulative portfolio, right? It generally has upper limits. Even risk XOL has upper limits for that matter, but aggregate XOL has specific upper limits and basically has an excess point that's higher than the working layer. So can anyone tell me why that is the case? Why is the excess point of aggregate XOL always higher than the working layer? Two reasons. What does this mean? Excess point higher than the working layer. What does that mean?
The deductible will be higher than the EML of the individual risk, basically.
Fair enough.
Uh,
So why is that? It's not higher
so
than
since
the
this is
EML.
an
It's not higher than the EML, but I will give it to you. But why is that?
Since it's an aggregate XOL treaty, we are reinsuring against multiple bad claims.
Okay.
So and each company would have its own capacity to bear such claims.
Okay.
So on a portfolio level, maybe in let's say company expects that I can bear 5 such claims, so I will have my excess at that level, which will be much higher than the individual risk EMLs.
Okay. But what is working layer though? What is the definition? We went through this, right? What is the definition of working layer? It is
So it is
the
a layer also that, like you
it
saw
is
in
the
the
layer
page,
above.
it is a layer at the, above the retention limit,
Correct.
above retention limit, where the maximum loss lies.
Exactly. So now when I have an excess point that is higher than the working layer, what does that mean? Why have it even like, why do you have an aggregate XOL in that case? If the working layer is, high, if the excess point is higher than the working layer, then what am I covering for? Why do I have it in the place? My working layer is, not covered, right? In the aggregate XOL. So why are insurers taking it?
So working layer operates at an individual risk level, right? But
Correct.
there could be many claims which can hit those levels.
No, not
So
necessarily. Working layer, I mean, it operates on an individual risk layer, but it can get aggregated. No, 10 working layers of individual risk
yeah,
is.
they can.
So there is a simple reason, right? I'll answer this. Simple reason. Lower premiums. If I am a reinsurer and if I am going to insure your working layer, it basically means that I will charge a higher premium. But I don't want higher premiums as an insurer because I want to only cover scenarios which are horrific for me. For example, I want to cover aggregation scenarios or accumulation scenarios. So aggregate XOL is used only for those kind of things. They're not used to cover working layers. Working layer is something that the insurer has to underwrite better for, right? That's the entire idea. So if I start covering my working layers, I have to pay a higher premium. And remember this, risk XOL, aggregate XOL, they don't have commissions. They don't have return commissions because this is exactly like a traditional insurance product that the insurer is taking, right? XOL and non-proportional products are all insurance products for the insurer. They're not capacity building products. So the insurer has to pay premiums, and over a long enough time frame, right? If you take like a 10-15 year time horizon, the amount of premiums that is paid by the insurer will always be greater than the amount of claims recovered by the insurer. So this is a cost center for the insurer. Quota share, surplus, they're not cost centers for the insurer, right? This is a cost center. This impacts the insurer's bottom lines. So that is the reason why working layer is never generally covered. Second point is limited number of reinstatements is a big feature for this. Just hold on, no? How do I think my class is going to go. I have another class now. Chalo, let's finish this. Aggregation is often happening by events and by perils. So what does that mean? It means that in an aggregate XOL, I have the ability to aggregate either by event or by peril. So, or by class also. So aggregate XOL can also be available by class. All right. We've gone through this. Like this is the advantages and disadvantages of XOL treaties. The advantages being that the insurers can accept large risks. Again, risk of insolvency is lowered because of XOL. The technical results are more stabilized because of XOL. And if an insurer uses XOL, they are effectively using more efficient use of capital. And what do you mean by this? It means that they are spending a little bit of money in terms of reinsurance premiums, and they are insuring large levels of risk. Sorry, you had a question, Ankur?
yeah, not pertaining to this, but your previous statement that
Technical
quota share is not the cost center
Ah.
to the insurer.
Ah.
So just wanted to understand, does that mean that insurers make money using quota share treaties? I do.
Absolutely, yeah.
Which is counterintuitive to me because why would reinsurer then make a loss on quota share?
It's not a question of loss. Think about this way, right? An insurer can place a quota share treaty with a reinsurer, right? The loss ratio for the insurer and the reinsurer is the same. However, the insurer gets a return commission, which means that the insurer is acting as a broker here, right?
So correct, but the insurer has also paid the commissions to the agents or the broker while procuring the main business.
Yeah, that is separate.
And the insurer might have also incurred some expenses in writing the business, which they are not recouping it.
No, you're right. That is separate. That is separate, right? But sometimes the insurer can share those costs with the reinsurer. Not always. Sometimes the regulations also do not permit this, but there are cases where the reinsurer can also cover the cost of administering policies with the insurer. Happens.
Right.
It happens. In that case, the insurer has no cost. Only
No,
direct.
the only reason why I asked was my understanding was that in a long term, the reinsurers will always make money out of any treaty. So may it be proportional or non-proportional.
They will make money out of any treaty provided the underwriting is clean. If the underwriting is not clean, nobody makes money out of it, right? Over the long term. You could continue underwriting in a very poor manner. You still end up losing money.
No, that is fair. That is fair. That is fair.
The assumption there is assuming that the underwriting is clean. You are right. But for the end insurer, what happens is that the commissions effectively become a source of income for them. It's a cash flow problem, not a profitability problem.
Correct.
It's a cash flow. You have to approach it from a cash flow, this thing. I think somebody is. All right. So good thought experiment for you guys to run, which is for these liability line, for these not liability line, sorry, for these lines. Oh, sure. So sorry, I forgot about stop loss. So stop loss is final non-proportional line designed to stop losses, and it's generally stopping losses over a specific period, and it stops losses when losses exceed either a monetary amount or a percentage of the company's premiums, which is effectively loss ratio, right? So for example, a stop loss could effectively be a treaty that covers, say, a company's loss ratio between 110 to 150%. So if the company loss ratio exceeds 110%, but is under 150%, the stop loss will cover the gap between that. So if the company's loss ratio is 120%, the stop loss program will cover 10% of the loss ratio, right? Which effectively means that as long as the company can keep the loss ratio between 110 to 150%, their net loss ratio will always be 110%. So why take it? Sometimes there's uncertainty in loss of in a line of business, or sometimes there's a new line of business where they have no claims experience. So stop loss is generally taken in those cases. Good thought experiment is for these following lines: motor, liability, commercial property, aviation, crop, and travel. Think about whether stop loss cover is viable and whether or not stop loss covers are available for these products. So it might be a good thing for you guys to talk to your teammates if you don't know it, to understand what these are. Right? Let's quickly go over FinRe products. I'm already late, so I'll just take it in a couple of minutes here. So what are FinRe products? These are risk financing products. They're more focused on smoothing results, and they are limited more to, there is only a limited amount of risk transfer that happens. So these are not traditional reinsurance products, but these are risk financing products, right? What are the main features? There is almost always a limited assumption of risk with the reinsurer. And these contracts are always often multi-year contracts. There is an explicit inclusion of investment income, which is not there in other cases, right? In quota share, for example, the premium is invested, the reinsurer gets the investment income. The insurer doesn't get it. I think this answers your question, Ankur, as to why quota share always makes money for the reinsurer, right? It's not only that's how they also make money, right? Investment incomes. Then there is sharing of results with the cedent, and there is risk transfer and risk financing being combined, which is very different from what traditional reinsurance products are, right? Typical examples of FinRe products: time and distance deals, spread loss covers, financial quota share, industry loss warranties. There are two types. One is pre-funded arrangements, where the insurer pays upfront and recovers reinsurance claims from the fund to which they are making payments. The other one is the reinsurer pays the losses upfront and then recovers losses over time. So there are two types of FinRe products. So broad question for you guys to think about and mull over. Why does FinRe exist? We have already had this discussion to a certain extent, but good for you guys to think. It's a good thought experiment to think. Right. Now, what are the products? What are the features of each product? And what are the different products that are there? So with time and distance deal, so what is the product? Simple. insurer keeps paying premium for a in return for a fixed schedule of future payments, effectively an annuity, right? They'll pay a premium for 5 years, and then the reinsurer will pay annuity after 5 years for another, say, 5 years. So why is this? What is the feature over here? The annuity payments are actually treated as RI recoveries, which go towards lowering the liabilities for the insurer and improving solvency. One important point is that in many jurisdictions, including India, time and distance deals are not legal. They've been made illegal because of the fact that your annuity, and it's a very complex thing, right? So most regulators take a look at it and say don't. Second is spread loss covers. So spread loss cover is very simple. Insurer keeps paying a premium to a fund. That balance keeps accumulating along with investment income and interest. Finally, at the end of the year, the fund gets settled, and usually the insurer has the option of taking money from that fund towards any exigent claims, right? For example, any earthquake claims. So insurer will keep paying for 10 years. And during the 10 years, if there's a, God forbid, if there's an earthquake, the insurer can take money from that and claim reinsurance recoveries. So that way, effectively, it becomes like a managed solution, right? Third is financial quota shares. Financial quota share is the same as a quota share, only that the commission structure is very different. So in the initial period, the commission is overpaid. And then in the later period, the commission is underpaid. Effectively speaking, you're playing with the money that gets paid to the insurer, right? So the insurer can use that money for financing deals. And the fourth one is industry loss warranties, which is not even an insurance product. It's a pure derivative product. The basis of cover is not indemnity, but effectively the net losses that are suffered in the industry. So most of these will not even be, we don't need to bother. Finally, we have runoff solutions. So what is the aim of runoff solutions? The aim is to transfer reserve development risk. When are they used? They're used for cases where there is corporate restructuring, when there is an M&A, when there is when an insurer is closing a line of business, when there is regulatory tax and changes, when there are legal developments, right? What are these? The two types of products. One is adverse development cover and one is loss portfolio transfer. Then what do? They basically offer reinsurance for a closed book of business, right? For example, any asbestos related claims in the US generally has runoff solutions that are there. The two types, one is adverse development cover, like I mentioned, which basically covers the ultimate settled amount for a specific book of business, and it protects cedents against deterioration of reserves. What is the market practice? Generally speaking, you cannot get unlimited covers for this. The attachment point is generally very high. The insurers would have to have some participation in the cover, and the insurer is still exposed to credit risk. So good question for you guys to answer. What is credit risk? Why is an insurer exposed to it? Right? We will discuss this when we do, credit, when we do different types of risk. And what is loss portfolio transfer? Loss portfolio transfer is more of an exit solution than an insurance cover, reinsurance cover. It's when a liability is completely transferred from one entity to another. It's called novation. Most of the LPT solutions are covered in SA3 and not in SP7 and SP8, although it's a good thing for you guys to know what these are. The original insurer transfers reserves to a completely new entity, and all adverse claims and any investment income are transferred to the new insurer. There are pros and cons. I'm not going to go into that because we are way out of time, but I would urge you guys to go through that. I hope we can close this lecture. You guys have any questions?
Yeah, Sunil, I wanted to discuss some things, but I've also signed up for the SP8 class. So maybe after that I can discuss. No worries.
Perfect.
Well, nothing as of now for me. I'll go through the course material for this topic.
Okay.
And maybe later on if
So
needed.
the idea is very simple, is to provide provide the material in simple to consume mind maps so that it's easy for you guys to revise as well, right? So that's the whole idea over there. All right.
Sure. Yeah.
Okay, guys. See you. Thank you. See you next week.
Thank you.
Thank you.